I'm Mahesh Lal, and obviously I am going to be assisting you with accounting for today. Right, a huge shout out before we start with the actual lesson to our sponsors Liberty. And guys, please remember, if you did not download the Tenfold education app, please make sure you do so ASAP, because that app is going to help you with your accounting revision, not just accounting, obviously various other subjects as well. Right, so let's get started. In today's lesson, our focus is on cash budgets. Now remember, you guys obviously did cash budgets in grade 11 as well as in grade 12. So what we're going to do in today's lesson, we're going to start off by focusing on some concepts, some key concepts that you should be familiar with, concepts that were already taught in grade 11. So let's start off with something very, very basic. What is a cash budget? Now remember, when we talk about the word cash, we are referring to the inflows and obviously the outflows of money from a bank account. So remember, inflow of cash, money is obviously going into your bank account. Your bank account is increasing. Outflow, on the other hand, money is leaving your bank account, and your bank account is obviously now decreasing because you're making a payment. So that's as far as the word cash is concerned. Inflows and outflows of money going into and obviously leaving your bank account. Let's now focus on the word budget. So remember, when we talk about a budget, we're obviously looking into the future. We're trying to establish what we expect to happen in the future. And the correct term to use is we're trying to forecast. So what exactly are we trying to forecast? We are trying to forecast the amount of money that's going to go into our bank account. In other words, the inflows of cash, as well as the payments or money that's going to be leaving our bank account, the outflows of cash, in order for us to determine in the future what will our bank balance be. Right, now remember, when I talk about we, I'm obviously referring to the business. So a cash budget looks at a business's bank account where you're trying to establish the balance of that bank account in the future. So the actual definition of a cash budget, and I know there's a lot of repetition at the moment, but this is important because often this does appear in your exam where they ask you to explain what is a cash budget. So a cash budget is a forecast. Remember, we're looking into the future of future receipts, money going into your bank account, versus future payments to establish the cash position of a business for a future period of time. The business is also able to establish whether there'll be a surplus. Surplus means money left over of cash in their bank account, or if there'll be a shortfall of cash over the next few months. So shortfall, obviously, you don't have enough cash in your bank account. Your payments are higher than your expected receipts. Right, so cash budget, the definition out of the way. Let's now focus on what is a cash receipt. Now guys, this is very, very important because often what we find in the exams, you guys tend to confuse a cash receipt with an income. So let's look at the definition of a cash receipt, and then I'll talk about an income. So a cash receipt refers to cash that the business will receive in the budgeted months. So remember, the word cash, actual cash that is going into your bank account. So here I'm telling you guys, think physical cash deposited into the business's bank account. Okay, so it's got to be money going into my bank account. Right, so examples of cash received are cash sales. Notice I'm not using the word sales, but rather cash sales. Because remember, a business can also sell on credit. So when a business sells on credit, obviously the business is not receiving money at that point in time. So cash sales is physical money that the business would receive that would go into your bank account. Then receipts from debtors. Now remember, when you sell on credit, obviously you are not receiving money at the point of sale. However, when your debtors pay their accounts, when you now receive payments from your debtors, then obviously that becomes a cash receipt. Money is now going into your bank account. Then a fixed deposit when it matures. Now remember guys, a fixed deposit, you obviously take money out of your bank account, you invest it in a different account to earn a higher rate of interest. So when that fixed deposit matures, or when that time has now expired, it could be a year, it could be 2 years, money now flows back into your bank account. So that is a receipt of cash. Taking out a loan, another example. So remember, when a business borrows funds or you take out a loan, money goes into your bank account. So once again, it is a receipt of cash. Other examples: receiving interest, receiving rent, receiving commission. And then finally, the last example that I'm giving you guys, when you sell business assets for cash, in other words, when there's an asset disposal, obviously that selling price is the amount of cash you've received, and it is also a receipt of cash. So as you can see, I've mentioned only examples where the business is receiving cash. Now remember, an income, obviously an income, money or money that you are expected to receive due to a sale, due to letting out your property. But remember, an income is for a specific period of time, regardless of whether or not that money was physically received. Okay, so do not confuse an income with cash receipts. Here the focus is on cash receipts, physically receiving money, and that money is going to go into your bank account. Right, let's now turn our focus to cash payments. So once again, guys, I'm going to ask you to remember that there's a big difference between a payment and an expense. Remember, an expense is not necessarily a payment. A payment is not necessarily an expense. So the focus here is on cash payments. Right, this refers to the payment made by the business during the budgeted months. Think of physical cash withdrawn from the business's bank account. So in other words, it's got to be money that is now leaving your bank account. A payment, money being withdrawn from your bank account. Right, examples: cash purchase of stock. And once again, notice I haven't mentioned credit purchase of stock. The focus is on cash purchase. Cash purchase, I buy trading stock, I pay for the item immediately, money is now leaving my bank account. Then when you buy on credit, obviously when you now make payments to creditors, money now leaves your bank account. Investing in a fixed deposit. So if you now decide to invest in a fixed deposit, you will then withdraw a certain amount of money from your current bank account, transfer it to a different account. So that obviously decreases the money you have in your current bank account. So it is obviously a payment. Then when you make a payment towards your loan, towards interest, towards rent, etc., payment of operating expenses. So for example, when you pay water and electricity, salary, wages, telephone, and so on. When you buy fixed assets for cash, when you pay installments towards that fixed asset. So once again, money is now leaving your bank account, and obviously that's regarded as a cash payment. And then finally, the last example that I'm giving you is cash withdrawn by the owner. So remember, drawings, when the owner takes anything out of the business for personal use. But remember, in a cash budget, the focus is only on the cash that the owner has taken from the bank account or from the business. Right, then another very important concept for us to mention at this stage is your non-cash items. So here we're talking about certain items that you're going to come across. Could be an income, could be an expense, but it's not a payment of cash, nor is it a receipt of cash. So we refer to these as non-cash items. There are certain expenses and income, as well as other transactions which do not affect the business's bank account. In other words, not all income are receipts, as I explained earlier on, and not all expenses are payments. Right, so your examples of non-cash items, depreciation is one such example. So remember, depreciation, the value of my fixed asset is decreasing over time, but it doesn't mean that money is now leaving my bank account. So depreciation is an expense, but it is not a cash payment. So please remember that. Then bad debts, another example. A debtor has not paid his account and I write off this as a bad debt. So once again, physical cash is not leaving my bank account. So I've incurred an expense, however, not a payment. Profit or loss on sale of asset, another example of a non-cash item. And remember, when the owner takes stock for personal use, yes, it is drawings, but please remember it is drawings of stock, not drawings of physical cash from the bank account. Okay, right. I know we're covering quite a bit of concepts, but guys, this is absolutely important. In other words, before we now rush to an actual exam type question, let's recap on these concepts, because these concepts are, like I said, important, often appear in your exam. Right, so let's now turn our attention to what is a surplus, what is a shortfall of cash. So remember guys, when we talk about a surplus, it basically means that your total receipts is greater than your total payments. In other words, your total receipts exceeds total payments. Then we will expect a surplus amount of cash in our bank account. In other words, money is left over. Right, if however payments are more or greater than receipts, there will then be an expected shortfall of cash, or often what we call a cash deficit. Okay, right, and then finally the very last bit of theory, and then I promise we'll get to an exam type question. Why is this important? So think about it. Why is it important to draw up a cash budget? Now, obviously, a lot of you probably receive a monthly allowance, and even though you don't physically write down how you're going to spend that money, you know more or less how you're going to plan on spending that money. So by us looking into the future, by us looking at cash receipts I'm expecting to receive in the future, or my cash payments that I'm expecting to make in the future, it helps me to plan. It helps me to forecast, and obviously, like I said earlier on, it helps the business to monitor the payments from the account versus the receipts, money going into the account. Right, so why is this important? It is an essential tool to monitor and plan the liquidity. Liquidity obviously means cash flow of the business. The business is also able to assess whether or not they have sufficient cash to meet short-term commitments, such as paying your creditors, paying daily or monthly operating expenses or not. Will I have sufficient cash to pay off my current liabilities as well as my operating expenses? The business is also able to determine whether or not they can purchase fixed assets for cash, or rather, should I buy on credit? And then finally, do they need to arrange for an overdraft if there is a forecasted shortfall, or do they need to make alternate plans? So the key here is you are looking at the future. You're trying to establish whether or not there might be a problem in the future as far as liquidity is concerned, and if so, what are the plans in place? Okay, right, so quite a bit of theory that we've gone through, and remember, like I said earlier on, I know I'm repeating myself quite a bit, this theory is important because it's often asked in your exam.